I'll now hand over to Roberta Skliros, who started the session. She's the Assistant Auditor-General Financial Audit, recently appointed, and she's going to take us through the importance of financial reporting. Thanks, Roberta.
Thanks, Andrew. A little bit of a different pace here with financial reporting compared to the other sessions, but a passion of mine. Look, every set of financial statements tells a story. It tells a snapshot in time about the economic activity and performance of an entity, and every year a new chapter is added to the story. Thinking about 2019-20, this is clearly a year where the story has had a few twists and turns. It's a year where financial reporting needs to be more than a curious glance. It requires a strong focus by boards, audit committees and audit. Many organisations in the Victorian public sector will be impacted by uncertainty and change. Uncertainty relating to the consequential impacts of the government's measures to contain COVID-19 and its response to support the economy and community. And the change relating to the suite of new accounting standards impacting the public sector this year. In my time with you today, I want to highlight the financial reporting implications associated with COVID-19, the government response to financial reporting timing, and the subsequent impact to our audit delivery. I'll also provide some brief content around the new accounting standards and what you can expect to see in your agency's financial reports. And I'll leave some questions with you that you may wish to ask management and your audit during the year-end process. For critically impacted agencies, the effect of financial reporting may not be the first thing that comes to mind as a consequence of the coronavirus outbreak. However, I think we can all agree that the economic uncertainty and heightened government expenditure creates a vital need for transparent financial reporting for all users in the Victorian community. This view is echoed across the accounting industry internationally and also more locally by the Victorian government, as evidenced by the two quotes I leave you with on this slide. Therefore, there's definitely an important role here for preparers of financial statements, audit committees and auditors. The impact of financial reporting will be heavily dependent on the facts and circumstances of each agency. Everyone's different. Early identification and discussion with management and your audit teams will inevitably reduce the pressure over the coming months on these issues. Today, I've pulled together some of the most common impacts that we're getting questions through our clients and audit teams. The first relating to financial asset valuations, in particular receivables. Agencies are going to need to consider any impact on receivables and assess whether there's any impairment. Impairment of receivables is governed by an expected credit loss model under the standards, and recent events may mean that default's more likely to occur for agencies of own source revenue. The other one that's come up a bit is the fair value measurement of other financial assets, such as investments. Now, when we look at this, for listed investments, there's limited risk because we use the market price when pulling accounts together. However, for unlisted investments, agencies should consider any uncertainties associated with the underlying methodology and turn their minds to thinking about potential additional disclosures in the accounts to adequately disclose and be transparent about any uncertainties with those investments. Another common query that we're getting through our audit teams is regarding scheduled revaluations this year. So for agencies undergoing a full scheduled revaluation, the current environment raises a risk as to whether values can actually undertake an effective valuation. We've had some preliminary discussions with the Auditor-General's office on this matter, and at this point it's expected that valuers should be able to determine fair values. However, you might see in the valuation report some risk adjustments and specific disclosures about the current environment or about the associated valuation itself. So from a financial reporting perspective, we'd expect to see the valuation methodology, any significant estimation uncertainty, or any other matter relating to the valuation disclosed in your financial reports. And the severity of the uncertainty on these values may impact the nature of our audit report or audit opinion, which will deal with agencies on a case-by-case basis. Another common query relates to relief packages. So just bear in mind, relief packages and additional funding. Management should pay close attention to the specific terms and conditions associated with any new funding or relief packages, because the accounting treatment can differ significantly in terms of when and how you recognise the funding. We've had some discussions on waivers, given that a number of waivers have been announced by government, for example, our payroll tax relief. or through some waivers of utility bills and alike for Victorians experiencing financial hardship. So again, we suggest that management focus on waivers, given the accounting treatment through your profit and loss statements can be a little different in these circumstances. Another area is going concern, which Andrew touched on before, and I note there's a question that's been raised in regards to this as well. The accounting standards require financial statements to be prepared on a going concern basis unless management intends to liquidate, stop operating, or has no realistic alternative but to do so. So in the VPS, economically dependent entities in the general government sector, for example, are probably at less risk here. So we're really looking at the risk more apparent for own source revenue agencies. And these agencies need to consider any impact on their accounts and their financial condition. The going concern assessment in preparing accounts takes into account both events before and after the balance date. So you need to consider whether any coronavirus related events have caused a significant deterioration in your financial conditions or whether they've introduced any material uncertainties to your overall organisation. In these instances, the accounting standards require explicit disclosure about any material uncertainty associated with your accounts. And again, depending on the severity here, our audit reports may be a little bit different in terms of emphasising these matters. And finally, subsequent events. So as you're all aware, agencies are required to identify events that take place between balance date and when you sign your accounts. 30 June reporters should just be aware of any government announcements or any other events that may impact on operations or financial performance during this time, because there's some specific requirements under the standard that may trigger either adjustments to balances or some additional disclosure. In response to the COVID disruption, VAGO reached out to DTF and DPC in March to understand plans to adjust reporting timelines. From this, a working group was established consisting of representatives from DTF, DPC, VAGO and departments to consider any changes to financial reporting timelines. Guiding principles for the working group really revolved around giving critically impacted agencies more time to focus on core services, for agencies to continue to operate as normal as possible in their corporate finance divisions, and for VAGO to keep auditing remotely as best as possible. And with the overarching purpose of acknowledging the importance of preparing financial reports during uncertain times. From this working group, revised timelines were approved and issued at the end of May. We also held similar discussions with Local Government Victoria regarding financial reporting timelines. So the changes. The state's AFR is planned for sign-off by the 24th of September to allow for tabling in mid-October. As a result, material entity financial reporting timelines have been shifted a little bit from prior years, but there's not much relief there. The state budget will also occur around the same time, just after the state's AFR has been tabled. Non-material entity financial statement timelines have been shifted significantly. The date to provide draft financial statements to audit has been extended by 6 weeks, and tabling of annual reports has been extended to 31 December. And for local government, the submission of annual reports has been extended to the end of November. I do just want to highlight though that these changes are provided as relief only. They're not a direct shift in requirements. So availing relief should only really be considered where client and or audit capacity has been challenged as a result of COVID. So I know you're probably all asking, what does this mean from VAGO's perspective? Reporting timelines, as we all know, are challenging in a normal year, and the coronavirus crisis has created additional pressure for all of us, from homeschooling to access to information, availability of key personnel. For VAGO to be able to achieve our timing associated with the state's AFR, the material entities and the budget all at once, this becomes our primary focus. And non-material entity financial statement audits become a secondary focus. Now, what does this mean? Given the primary purpose, some of our non-material entity audits may not occur until post-September, but we suspect this will be mostly for audits done by in-house audit teams at VAGO. Some of the non-material entity audits may continue to occur on your normal timelines, and we suspect that these will be by our outsourced agents. However, there is a risk that our capacity to turn around opinions may be challenged a little bit, but we are working to try and obtain further resources to help us manage these risks to avoid any significant delays for your agencies. In terms of local government, we're trying to work with the sector as closely as possible to limit any delay. The change. So many firms in the private sector spoke of a triple threat hitting not-for-profits this year, being the new revenue, income and leases standards. But this year for the Victorian public sector, we actually have a quadruple threat because DTF determined early adoption of the service concession arrangement standards. While some entities may not be impacted by all of these standards in a major way, most will have some impact. As foreshadowed by ASIC in 2016, these standards have shaken things up for preparers and auditors. The standards are principles-based. They require consideration of all facts and circumstances beyond contracts, and there's a lot of judgment that needs to be made. They also require changes to business processes and practices to enable entities to capture the right information for accurate accounting. Let's start with the revenue and income standards. These standards set out new models for revenue recognition for contracts with customers and income recognition for not-for-profit entities. They're likely to change the current accounting for certain types of revenue and income with regard to how much revenue and income is recognised and when. AASB 15 establishes a 5-step model to account for revenue arising from contracts, and AASB 1058 covers accounting requirements largely relating to government grants, contributions, and some explicit requirements on capital grant accounting. What's the difference? For a transaction to fall within AASB 15, there must be an enforceable contract with a customer, and the contract must include sufficiently specific performance obligations that promise to transfer goods or services to a customer. So if a transaction falls within 15, revenue is recognised when the performance obligations are satisfied or as they're satisfied. So essentially either evenly accounted for over the life of the arrangement or at distinct points in time over the life of the arrangement. Should a transaction fall outside of AASB 15 because it doesn't meet this performance obligation criteria, income is recognised under AASB 1058, which generally occurs as the funding's received. These are two of the key areas we found most challenging with clients. Firstly, working out what's being transferred under a grant agreement. Is it a service? Is it an output? And secondly, whether the arrangement has sufficiently specific performance obligations to allow for accounting under 15, or whether an agency has full discretion to spend the funding based on overarching broad objectives. On the comprehensive operating statement, you can expect to see some changes in terms of major revenue and income streams. Amounts may increase or decrease depending on which standard they fall under. The balance sheet may also include some new balances you've not seen before relating to contract receivables, contract liabilities in the event that revenue is deferred. In the first year of recognition, the financial statements will also include some detailed disclosure explaining transitions to the new standard. You'll also see some ongoing disclosure year on year relating to all the varying types of revenue and income that are contained within your accounts and some reconciliation tables. It's key to note that DTF have elected to apply the standard using what's known as a modified retrospective approach. This essentially means that your comparatives from last year won't change, and any adjustments to the new standards you'll see taken through your equity statement. I've listed here for you a few questions that you may want to take with you to speak with management or your audit teams about at year end, and I'll ensure that we share these with you post the event. Moving on to leases. Why the change? So the previous lease standard focused on identifying when a lease was economically similar to purchasing an asset. When a lease was determined to be economically similar, that lease was identified as a finance lease and booked on the balance sheet. but all other leases were classified as operating leases and not accounted for on your balance sheet. Regulators and investors raised concerns to the standard setters that this approach lacked transparency on lease obligations. So responding to those concerns, the development of the standard commenced. The standard fundamentally changed accounting for lessees, with the distinction between finance and operating leases now removed. Lessees now recognise all leases on the balance sheet as right-of-use assets with an associated liability. And DTF have elected that the asset associated with the lease is to be measured at fair value. The assets are now depreciated and an interest expense is included from the lease liability in your income statement. The lessor accounting has unchanged from the past. Are there any exemptions? Yes, there are. The standard doesn't require you to account for short-term leases, being anything less than 12 months, or for leases of low-value assets, such as a personal computer, mobile phone or laptop. On the comprehensive operating statement, you can expect to see interest expense from the lease liability and the depreciation charge relating to your asset. The balance sheet or notes will have your right-of-use assets classified differently to all your other assets. And likewise, you'll have your lease liabilities disclosed separately, either on the balance sheet or the notes. In the first year of recognition, the financial statements will also include some detailed disclosure explaining transitions to the new standard. And you'll also see some specific disclosure in the event you've got peppercorn leases or where specific exemptions have been used from the standard. Consistent with the revenue and income standards, DTF has elected to apply this standard modified, therefore no change in comparatives will be seen. And again, I've got some questions here for you that you may be interested in asking your auditors or managers throughout the year-end process to give you some comfort when recommending accounts to those charged with governance. And finally, the service concession arrangement standard. Before the development of this standard, there was no definitive accounting guidance in Australia to account for concession arrangements. This standard now addresses this. So for a long-term contractual arrangement to fit under this standard, service concession arrangements are contracts between a public sector entity and an operator, where the operator is required and uses a government-controlled asset to provide services on behalf of the state. The operator has to be responsible for some of the management of the public services from that asset, and the operator must be compensated for the services they provide. If those three conditions are met, the grantor records a service concession asset and a liability on the balance sheet, and the nature of that liability will be dependent on the nature of financing in the arrangement. Previously, PPP arrangements were accounted for under the lease standards, with the exception of arrangements where the state didn't contribute to the financing, such as CityLink and the toll roads. Some previously recognised PPP arrangements may not actually fit under the new requirements of this standard, and they'll continue to be accounted for under lease accounting. Just to highlight, if your agency does have arrangements like this, the scope and control concepts of this standard are quite grey, and they require significant management judgment based on all facts and circumstances of the arrangement. I think it's fair to say in a lot of our consultations and considerations around this space, we're having to take a stand-back approach to consider what faithfully represents the transaction and the arrangement to determine whether it fits in the standard. Transition disclosures in the accounts will contain details around early adoption of the standard, as I mentioned before, by DTF, and explaining the old world and the new, essentially. Unlike the other standards, comparative figures for the service concession arrangements will actually be adjusted because DTF have elected to account for this standard as if it's always existed from the beginning of a contract. So that's just something that's different. The standard also requires some disclosures on for agencies to basically explain the finer details of material service concession arrangement. And again, I've got some questions here if your agency is faced with a service concession arrangement in your accounts for this year end. To assist agencies in implementing the new accounting standards, DTF have undertaken a few things. Firstly, all the standards contain a number of options and elections for agencies to apply when transitioning to a new standard. So to ensure consistency in application across the public sector for varying reasons, including consolidation, DTF have imposed specific requirements through financial reporting directions. And Local Government Victoria have done similar through their guidance for the agencies. DTF and Local Government Victoria have both separately prepared additional guidance papers and model financial reports to assist agencies in preparing for the new accounts. And also new model reports have been prepared across sectors such as water and health to assist in transitioning to the accounts. And that was all I had on the financial reporting leading into year end, Andrew.
Thanks very much, Roberta. We have got a few questions. There was a question about, just a point of clarification, what constitutes a material entity. That's something that we determine as auditors because we have to audit the whole of, this is for the state government, of course, not local government, when we audit the state's annual financial report. And really the definition is pretty straightforward. If your income, expenditure, assets or liabilities are material to the state, you're a material entity. When we look at the list each year, it doesn't change much. We've got about 23, 24 entities in that list. Some of them are hospital services or the government departments, and a few other strange ones on the surface because they might have a significant PPP or a particular valuation issue. That list is shared with DTF. And that's what we're focusing on in terms of what we call material entities. And the other question that I think Roberta answered, will audits be delayed? We would hope not, but we expect so. But the point was, and someone's made a point that committees are also being challenged because they're being told that delays happen and deferrals occur because of COVID, and it's really hard to unpick whether or not that's a legitimate excuse and response or not. And I'd suggest it's as tricky for the external auditors as it is for audit committees to unpick that. And it's just about probing and really trying to understand whether or not that deferral is appropriate. But the point we were making about financial reporting, I spoke to all the Auditors-General around Australia a few times over the last month, and we all agreed that what was of paramount importance for the state government to maintain public trust in the institutions of government is that the state could produce its annual financial report on a timely basis. And so that certainly has been the focus of DTF and DPC, and we've agreed that we should also have that focus so that we can contribute to that outcome. Now, that may mean that some of the smaller entities, what we call the non-material entities, there will be some delay or deferral. We're hoping that as it pans out, if some of them take relief and some don't, we may be able to manage it so that we can meet everybody's timeframes. But it'll be really important to talk to your sector director for your agency and understand what we're doing in that space. There was a question, Roberta, that I've got for you, and then after that we might open to the general questions because I can see one I've got for Dave as well. But there's a question which goes back to, you mentioned post-balance date events. And of course, one of the key post-balance date events this year is that the budget will be handed down in October or late October, maybe November, which could significantly change organisations' future financial prospects, for example. So that's one post-balance date event. But the question is, what if there's a second wave of COVID-19? What's the response there?
In terms of between balance date and signing of the accounts?
Yeah, well, let's hope. Yeah. Let's hope there is no second wave. But let's hope if one does emerge, yeah, it doesn't emerge until post 30 June. So what would we do there in terms of post balance date events?
So I think we'd need to explore the timing of when that happens and the impact that has on the agency itself, and we'd have to consider then whether it's significant enough to warrant disclosure, or if there are significant impacts to balances or the going concern assumption moving forward. Then we'd account for that and consider in the financial report the disclosures.
Yeah, look, I think you're right. I mean, I'm very much pro disclosure. I think you can't disclose enough as it relates to things like this. We've just obviously been through the 31 December reporting season for universities and TAFEs, And if you look at their published financial statements, you'll see a lot of disclosures about the impact of COVID-19. And of course, the most recent reporting this week, some inferences or suggestions that some universities may no longer be going concern. So they're obviously refuting those and batting them away. But these are the types of things we need to worry about.
And I think it's important, Andrew, with that example, just to advise that the audit report itself may look a little bit different in those instances. So what our learnings in the education sector, we had emphasis of matter in our audit opinions, just highlighting those disclosures in the accounts because we thought that they were of high importance to draw users' attention to.
Indeed. Thanks, Roberta. Look, we might go into the broad Q&A now, so I'll invite John and Dave to also turn their mics on. I'll start with Dave. There's a question for you, Dave.
Yeah.
You spoke about data protection tools. Can you talk more about what tools Vargo uses?
Okay, good. Thanks, Andrew. I had to quickly scan that question and tried to jot down a few notes. And look, I might also cover off on another question in there that talks a little bit to standards because I think they're linked. So the first thing I'd say is that once you get orientated in this environment, it's really straightforward. Whether you look at ISO 27001 or NIST, it's all the same things. And the way you can do this is using one of the tools. The way you can verify this is using one of the tools that we use, which is called the Microsoft Compliance Center. And what it actually does is it takes Microsoft's controls and your controls and maps them against the standard. So for example, if you have a user onboarding and offboarding process, it says this satisfies these obligations under these standards. Probably the biggest tool we use though is not so much at this standards level, but more at a controls oversight level, which is we use a tool called Secure Score. And that really looks at your entire environment and it says, here are some actions you should take, and it gives you a score for every action. So, and it also breaks it across different dimensions. So for example, identity protection, endpoint protection, etc. So in relation to identity protection, I know you get a score of 50 for having MFA enabled as an example. And that's a really, really great starting point. I would ask anyone, what is your secure score? It's not definitive, but it is a very strong signal and a very strong guide. The other things we use are things in Azure Active Directory. So we use identity protection to monitor, that delivers a whole heap of controls like monitoring unusual logins, irregular travel, that sort of thing. We of course use MFA, although we're about to move away from MFA and move to the next wave because MFA is not without its challenges too, although it's immensely powerful. And we'll go passwordless over the next year. So as you know, MFA is centered around something that you know in your password and something that you have in your phone. When you go passwords, when you go passwordless, it's around something that you have in your phone and something that you are in terms of like biometric recognition would be an example. Across our privileged users, and I won't go on too much about this, but I'll just do another 30 seconds or so. Across our privileged users, so those people that have the highest level of privileges, we use a thing called least privileges model with just-in-time access. So to get access to our systems, you get it for a duration between 3 hours and 12 hours. And the highest permission level, either myself or Andrew have to approve. And then finally, we use tools like Azure Information Protection to mark all of our information. And again, and I talk about Microsoft a lot, and I did hear the Microsoft CEO talk recently, and the question he was asked is Microsoft now more of a security company than a software company? So we use Azure Information Protection to mark our documents at a metadata level and visually, and then we also use things like data loss prevention and cloud access security to monitor our document flows and dynamically respond to those documents. We use a whole heap of other tools like Qualys to monitor our network internally, ATP Defender to manage our endpoints, and Intune. But if all of these sound like unfamiliar things to you, I can assure you we deploy them really, really quickly. I mentioned last year we deployed AIP with about 1 day's effort. We've recently deployed Intune with about a week's effort. We have deployed PIM again with about a week's effort, and in a elapsed time typically of about a month. So these tools, as I mentioned last year, are things that you can now rapidly deploy with really quite a low level of professional skills and they advance your environment significantly, and they're things we could never do in another world. So hopefully that gives some answer to the question.
Yeah, thanks, Dave. Look, we may stay on the security bent, and I'll ask John to answer a few questions. I'll try and bring them together. There's an observation about DHHS, which mandates its 72 IT controls, and I'd remind the people watching that we actually did a performance audit of security of patients' hospital data last year, and I'd recommend a read of that. It was shortly after that we had that cyber incident out in the health network, and the question was, well, what's our confidence in those measures and the relationships, which is kind of spelt out there.
I was going to mention that was the question that I was trying to also cover off on. Yeah. To say my observation of no matter what way people dice this data, it's always the same type of thing that they're trying to achieve.
Yeah, yeah. So John might have some comments following yours, but also, John, I guess the other question is, from your perspective, you may wish to answer it or not, is who do you think in Vic government is leading practice in this space?
Yeah, thanks, Andrew. I'll do the last question first, if you like. So to be honest, I don't think there is any department or agency that I've come across that's nailed everything. So, but there are pockets of goodness, and to give DHHS some credit, I guess they've been on their cybersecurity uplift journey now for probably about 3 or 4 years. And why? Because the impact to the community of hospitals getting popped, like with what happened at the end of last year, is pretty significant. So, yeah, one of their leads, James Fell, was their Chief Information Security Officer. And he did a lot of work around those 72 controls. So one of the things that the cyber security professionals confuse the hell out of the general community is that we have no shortage of frameworks, and people say, well, which one? Sometimes it's a combination of the two. So those 72 controls that DHHS now implemented and monitor, would they definitely uplift cyber maturity across government? Certainly. But for some of the smaller entities, maybe that's a little bit too much. And so as a team, we're going to be pushing something called the ASD Essential 8. And that is a discrete set of controls that will help improve cyber and bring it up to a minimum level. I think also, to answer your question, I don't think there's one size that fits all across government. So I think some of the services and sectors require a higher level. Like if you're a digital hospital, that should be the case. And so we're trying to come up with a baseline, and if departments or agencies want to exceed that, that's sensational.
Thanks, John. Excellent. Look, I'm going to ask Roberta to answer a few questions now, but before I jump there, there's a question about, it came up very early, in fact, should committees and or boards meet independently with the external auditor to discuss audit outcomes and management issues? It's always been the case that good practice is that the committee meets privately with the external auditor, but I also recommend that the committee also meets privately with management and meets privately with internal audit. I think there should be a triangulation, kind of a three-way conversation. The committee should hear from external audit its views of management and its views of internal audit, but equally it should hear from internal audit its views of the other two, and of course of management. So we absolutely encourage that, and of course technology like this can enable that. I actually had my audit committee meeting on Monday last, and we had a private meeting first, and then we joined into the general meeting after that. So I'd absolutely encourage that, as I encourage all committees to invite external audit to attend their meetings and in fact stay for the whole meeting. I think that would be good practice as well. Roberta, there's a question. You mentioned the DTF model financial reports and the guidance. There's just a question about the timing of release of those.
Yep. Thanks, Andrew. DTF are currently working on the model financial statements at present, and they've advised that they should be released by the end of June. For the other sectors, such as local government and water, the model accounts have been released for those, and Vargo provided input. In terms of the guidance papers, DTF prepared these guidance papers about 18 months ago to help agencies through the state budget development last year, as the state budget reflected some of the changes in the accounting standards. So finalised versions of those apparently will be issued around June as well.
Great. And there's another question, and it goes to not so much post-balance date events or events that exist as at 30 June, but what's gone on in this last 6 months. Is there any expectation we have that agencies should disclose the kind of market volatility and the investment returns experienced over the past 6 months?
Look, I think that's a really great question. I think if there's been a dramatic impact to your accounts in terms of either your revenue or your asset values as a result of it, definitely more context to explain the movements, the better. Your financial instrument disclosures as well have avenues to help you explain things such as equity risk or any liquidity risk coming out of it. And bear in mind too, if you've got some of those really tricky investments where the valuations underneath are unlisted and a little bit complex, the standards also call out for some disclosure around what's known as estimation uncertainty. So you'd be able to explore that with management to see whether there's a need for disclosure there. And yet we would expect to see it if it was a material impact.
Thanks very much. I see there's a couple of observations. We've got a new chair who's kind of lost in the acronyms, and I apologise for that. We quite often fall into this speak, and we mention acronyms like I know Dave's mentioned NIST, and that's the US standards that are published. So the plea is that we list all our acronyms and spell them out when we send out the pack. So that's for the producers behind the scenes just to take note of, so that we do that. And someone else made a comment. You were talking, Roberta, about the disclosure, the impacts this year in financial year 20. But of course, the observation was agencies should have disclosed the impact of these accounting standards last year. And of course, that's what the standards require. But I think our experience was that we didn't really get all the disclosures we were expecting in last year's accounts. Have you got a comment on that?
I think, Andrew, as we reported in our AFR report last year to Parliament, there was mixed application of the new standards last year in terms of disclosing the effect. So just for everyone's understanding, in the year before, or the couple of years before new standards come into play, agencies are required to estimate their impact and disclose how significant that impact's going to be on your financial reports. So for all the NFP entities this year where these standards are the first year of application, yes, disclosures in the past about their potential impact were varied, and therefore it sort of created some challenges and lots of work this year in getting through the issues.
Thanks, Roberta. Look, I can see we're kind of rapidly approaching the scheduled end for this conference, this virtual conference. I hope everyone's found it interesting and insightful. I've got a few questions that I might be able to quickly cover off. Does VARGO provide training for audit and risk committees around good governance? Well, no, the short answer is we don't. It's not in my mandate necessarily to provide training, and there's been a lot of debate over the last 2 decades about whether or not we even have the mandate to produce good practice guides. What we try to do, of course, is when we do audits, and when I got here in 2016, there'd been an audit done on audit committees and internal audit, is we try to spell out good practice in those. But I understand, that's a static document and we don't actively update and maintain that. But, again, each of my directors would be quite happy to work with individual audit committees to talk about what we think good practice is. Someone's asked the latest on electronic signature protocols. Look, I don't know. I can't answer that. We will look at this. John, you can?
Sorry, Andrew, I can.
Okay, Dave, over to you.
Look,
Thanks.
All I'll do is I'll just refer people to the Electronic Transactions Act. It's a Commonwealth Act. It's about the shortest act you'll ever read. And my observation is that there's huge deficiencies in traditional paper signatures. And like every time you introduce a new system, people don't see the deficiencies in the existing system, but they introduce all the deficiencies in a new system. The Act is quite straightforward. There's a range of ways of approving and signing documents, provided that you can do that in a way that's, provides suitable evidence. There's no particular form, and an exchange of email can absolutely constitute a approval and signature, as we regularly do in our organisation.
Yeah, look, Dave, I think, my experience of electronic signature protocols was more that getting people to accept and acknowledge that this could be done. So you're right, the Electronic Records Transaction Act and the Records Act provide for this, but people seem reluctant to. As I said, I was still physically signing warrants, and it was just the COVID crisis that got everyone on board. The governor and the treasurer, to saying, hey, maybe we can do this electronically. Maybe we don't need to be sending pieces of paper flying around the system. So
Yeah.
I hope that everyone looks at that. And of course, it's just another issue of security. You know, how do you tie down and lock down signatures? I can relate to you that on my website, you know, with our published reports and other things in our annual report, we did have people's signatures in those annual reports, and someone drew it to my attention that that signature could be lifted from the PDF version of the report and then used. So we've gone through and tidied up all our reports on our website to remove all signatures, for example. So I mean, it's a fairly complex but interesting area. Yes, I touched on the funding. Someone's asked, you know, are we looking at the challenges agencies having in enhancing their technology environment when they're not funded for this diabolical choice? No doubt. And we did actually have an audit in the program on cyber resilience. It's still in the program. We're just pushing it back 12 months, given that people like John's area and Centretex are focused on the immediate concerns of rolling out VPN and keeping it secure. But something we'll come back to definitely is cyber resilience. And
Andrew,
also,
can I just jump in quickly on that one as well? Sorry to jump in, but something I observe, a fundamental flaw with technology projects, is the horizon of investment is way too short. We wouldn't try and make a return on investment for a library or a swimming pool or a road stack up over a 3 or 5 year period. And we know most technology investments last at least, our lived experience is 20 years in the current world. So every technology investment fails because of what the questioner has correctly identified is the cost in transition, if you look at it over a 3 or 5 year period. But if you look at any technology investment over its useful life, it absolutely returns a positive cash flow. And as we know, in any business environment, if there's a profoundly positive cash flow, it's something that we should be securing through our reserves or through borrowings, because that's the essence of what we do. So for me, again, I'd encourage committee members to question why technology is seen in this short life cycle, this short horizon of investment, because that will cause every technology investment not to stack up.
Oh, look, I couldn't agree more, Dave. And from that perspective of, you know, the cost benefit analysis, clearly people need to take the longer term perspective. I think my observation, though, and I'm sure committee members have experienced this or spoken about it, particularly in the general government sector, is there is a leadership piece here, and I've observed this in the past, and there is to some extent a reluctance to invest in IT, particularly when you have major failures in terms of IT investments. And so one of the things we must look at is how well we govern and manage the implementation of IT. You know, we're all very acutely aware of the fines system rollout and the press and media on the problems with that. And we're all still minded of the payroll implementation in Queensland a number of years ago now that ended up costing over $1 billion. So I think there's also this this reticence or reluctance for people to face up to this and invest real money in it because of this concern that things will go awry. So we're actually having a look at the implementation of the new fines system, and very much I've asked my auditors to come up with the lessons learned. You know, what is it that we learn from this? How do we stop these things from happening in the future? And I think that will also remove a barrier in terms of investing in the technology that we need to. Look, there's an observation, and I take it absolutely on the chin, that sometimes my agents, my audit service providers, don't actually attend all audit committee meetings, and even if they do, they don't sit in for the entire meeting. Roberta mentioned that we're re-empaneling our audit service providers. We've spent the last 9 months, in fact, going through a process of setting up very strong criterion that we're now going to judge all our service providers against, with a view to rationalising the panel. And there will be criterion in there. There are criterion in there on security and technology, and as Dave said, you know, leveraging and enabling off our technology. But there'll certainly be criteria in there about how they're engaging with our clients as our representatives. So I hope, if you're experiencing that at the moment, that we overcome that through the new panel arrangements. We should have those panels established. We're looking at the end of this month, perhaps early next month, so that we can then go out and start tendering out the work that comes up from next year. Look, I've probably run out of questions. I don't know if we've got them all. I think there was a question early on about the impact of working from home on internal controls. I think that was the point of my presentation. And to take up this thread and this idea of the new normal and the better normal, it looks as though, from where we sit today, that we will be changing the way we work, that it is more likely than not that our staff will be working remotely, both audit and in agencies and in local governments, at least some days of the week. So as we move to that, we should be working on what does the new internal control structure look like? What does the new internal control framework need to be to accommodate that? You know, there's shifting in technology risk and security risk. Dave's mentioned and John's mentioned endpoint devices become critical here, and how you manage and control and secure the endpoint devices. Clearly, we would not want our employees to be using their personal devices because they can't be managed and controlled like a device that's issued by the agency with an SOE over it. So I think it is really important, and particularly audit committees now could focus on this new normal. Let's focus on the response, and let's make sure that what we're doing now is not wasting money. Let's making sure we haven't got holes in our internal control frameworks now, but then let's start having the conversation about what does the new world look like, and let's get into the design of internal controls. I think would be my closing comments. So look, with that, I might just hand back over to Roberta to close out. Thanks, Roberta.
Thank you, Andrew. Look, we hope that was an extremely informative session for you all. And we hope that you're able to take a few things away from each of the sessions as you work through these uncertain times. Just as a reminder, the recordings of today's presentations will be shared with you next week. And also any sort of slides that you may be interested in, we could arrange to make those available over the next week as well. So thank you everyone for your time.